The markets are not reflecting the mood here in Sandton, but let's just start off with the overall sentiment today. Down 0.8% on the JSE front. We've got commodities coming under pressure. Chinese PMI higher at 50.9 from 50.7, but in South Africa it's dismal, Ian. It's below 50, 46.7.
And you know, there's a whole run in commodity prices and in markets worldwide, especially in Asia, coming through into Europe initially. Just look at the Chinese PMI data. They said, hey, it's perilously close to 50, which is the break-even level between expansion and contraction in the manufacturing sector. And the world is relying on China's manufacturing industrial sector to give a boost to the whole world's industry and manufacturing. So I think that was pretty finely balanced, and I would not put a whole lot of hope in that buoying global equity markets right now.
Well, if we do see quite a bit of stalling coming through for the Chinese economy, Ian, does this also mean a lot of pressure for the Eurozone as a whole? We know that Germany is looking weak. We know that trade numbers for the second quarter globally for the G7 countries and BRICS are coming down significantly. We are starting to see significant slowdown. Is this because we're starting to normalize after the big increase that we saw in the first quarter, or is this going to be reality?
Oh, I don't think this is reality. I think we're going back towards reality now. I think that a large part of the recovery, starting from the last quarter of last year, the first quarter of this year, was all an inventory renewal. They were building up stocks, ready to get trading in business again, but what was happening is the stocks weren't moving off the shelves, not moving out the warehouses. And I think this is a problem, and all of a sudden, inventory started building up and getting stuck, and now there's a realization that there isn't the momentum to carry it through. So I think we have to get used to the fact that there's a whole lot more sorting out to do worldwide, especially in the old economies of America and Europe, before we can look to the Far East, China, India, to stoke a strong, lasting revival.
Let's touch on Discovery. A little bit of good news in today's session. We had full-year headline profits up 6%. We're starting to see quite a nice recovery, especially on the normalized headline earnings per share front, where we saw an increase of around 30% or so. Operating profit also up to the tune of around 30%. What do you make of this number? Is this really proving that the South African consumer and that Discovery, of course, are starting to tap into a market which is still set for a lot of growth?
Well, I think they probably have definitely had a very strong growth record up until now. But you know, certainly in the medical health area, it's getting a bit more of a mature market, and I can't see them keeping up that rate of progress. Their move into other countries is very interesting, into America, into the UK, and into China, all on a partnership basis, which is very good, I think. But we have to bear in mind that similar moves by the financial sector, especially into America, have not been very productive for other countries. For other companies, South African companies, but nevertheless, they've obviously got very tight management. I like the look of that, and the fact that they're keeping control, they're keeping costs under control, and I think that the whole overall strategy, the strategic direction is strong. It's a company that one needs to have.
Would you say that Discovery is a buy right now? It seems that most are of the view that it's looking relatively expensive. I know it's a tough market to read, but Ian, would you buy Discovery?
Well, as you know, I'm not really a buyer at the moment. But no, I think that the whole financial services sector is looking as though it may be under a bit of strain. I would want to have it on my shopping list, one that I'd like to buy if the market pulls back. I think the recent recovery we've had over the last 3 weeks is difficult to justify.
Let's delve into Marion Roberts, a company out with a full-year loss. Yesterday, those numbers were released, of course, holding back on that dividend. A bit of hope, I suppose, when the company does say that we could actually see a bit of a recovery, or the company could return to an acceptable profitability in the year ahead. Are you convinced, Ian, that the company can actually pull it off?
Well, you know, would I be a buyer of the stock? I'd wait to see the proof of the pudding is producing the results. And there's so many problems still possibly ahead. They warned of the fact there may be problems, further run-ins with the Competition Commission. They may not get the results they want from international contracts settlements. So there are a lot of hurdles still to pass, and I would just say give it time and let it prove itself before one goes rushing in to buy it right now.
Do you think that investors out there are going to start pricing in the good news? It seems that a lot of value investors, at least, have started to accumulate construction stocks. Some say it's slightly too early, but could we actually see a re-rating within the overall construction share price space?
Well, my view is on construction, we just have to look at the construction sector in the GDP data. It was marginally positive, but coming off a zero base. So, that's not really getting up into the higher steps. And the previous quarter was also only mildly positive. So I think if we just look at government fixed investment, there is very little fixed capital investment that the government is doing. In fact, they've almost ground to a halt since the World Cup. And for the private sector, with industry at the moment running at well below capacity, low capacity utilization numbers, I don't think that there's great prospects in the short term. Short term, even the medium term. What has to be looking 3 to 5 years ahead. That's a long while.
Okay, Ian, so let's touch on Optimum Coal and Glencore. We heard earlier this week, in fact, we were talking about a 14% stake taken up by Glencore, and now an offer seems to be on the table for the whole of Optimum Coal. What do you make of this space right now? We know that there has been a lot of murmurs and rumors about consolidation. We didn't know who was going to be acquired or who was going to be acquiring, but it seems now the proof is in the pudding, and Glencore is very much interested in Optimum.
Absolutely, and it shows there's an interesting partnership here between Cyril Ramaphosa's company and Glencore, and I think that Glencore's now got a massive access to cash. Since the listing, they've got a far stronger cash backing than they had in the past, and they're out to accumulate meaningful stakes in operators like coal. And I think, after all, Optimum is South Africa's 6th biggest producer. That's quite a significant size company. I think it shows they're moving away from purely trading-based activities into actual mining operating-based. I think that if they have anything like the success they've had on the trading side, that is going to prove to be a very interesting and positive direction that they're now taking. Once again, that's a company I would buy in at almost any stage. But I have a question to ask, and that is on the share price of Optimum. 2 weeks ago, the price was 23 Rand, and now it's 34 Rand. It got to 33 yesterday, before the announcement. Is there room for somebody's eye to be run over that and say, who's been pushing it up that far, that fast?
That's a very good question, Ian. I hope one that you could answer for us in the future. Thank you so very much for joining me. Great to have you on the program. Ian Cruickshanks, Head of Treasury Strategic Research at Nedbank Capital.